In the bustling markets of ancient Rome, a silver denarius once commanded a day's wages for a skilled laborer, its gleaming purity a symbol of imperial might stretching from Britain to Egypt. Over 3 centuries, emperors quietly chipped away at that silver, replacing it with base metals to fund endless wars and lavish palaces, until the coin was little more than bronze washed in a thin silver sheen. By the 3rd century AD, prices spiraled out of control. A pound of gold soared to millions of debased denarii, and the once mighty economy fractured under hyperinflation that eroded trust in the very currency holding the empire together. Today, a similar shadow looms over the modern world's reserve currency. Since the Federal Reserve's creation in 1913, the US dollar has lost more than 96% of its purchasing power, according to Bureau of Labor Statistics data, with everyday goods now costing 30 times what they did a century ago. What took Rome generations of gradual debasement to achieve, rendering its money nearly worthless, has unfolded in the United States in just over a century through persistent inflation and expanding money supply. This is not mere coincidence, but a recurring pattern in monetary history, where governments, facing mounting debts and commitments, turn to inflating the currency as a hidden tax on savings and wages. The central tension lies here. Can a fiat system, untethered from precious metals, escape the fate of Rome's denarius, or are we witnessing an accelerated version of the same destructive cycle? As inflation erodes the fruits of labor and savings alike, the stakes could not be higher in an era of unprecedented global debt and geopolitical strain. The dollar's dominance has afforded extraordinary privileges, but history warns that no currency is immune to the temptations of debasement when fiscal pressures mount. What Rome accomplished slowly through clipped coins, modern central banks achieve swiftly through balance sheet expansion, raising the urgent question, how much further can this erosion go before faith in the system itself begins to crumble? The Roman denarius began as a near-pure silver coin, weighing about 4.5 grams under the Republic in 211 BC, serving as the backbone of an expanding empire's commerce from the Mediterranean ports to the frontiers along the Rhine and Danube. Augustus reformed the system around 23 BC, maintaining high silver content at approximately 98%, which supported stable prices during the Pax Romana as trade flourished with provinces supplying grain, olive oil, and luxury goods from the east. The first significant debasement arrived under Nero in AD 64, following the Great Fire of Rome that demanded massive reconstruction costs. Nero reduced the silver content to 90% and slightly lowered the weight, a move that allowed the mint to produce more coins from the same bullion while funding imperial projects and military campaigns. This initial step set a precedent, as subsequent emperors faced similar pressures from barbarian incursions, civil wars, and the need to pay legions whose loyalty was bought with ever larger donatives. By the reign of Trajan in the early 2nd century, silver purity dipped further to around 85%, amid Dacian wars that brought temporary gold inflows but long-term fiscal strain. The trend accelerated under Marcus Aurelius during the Antonine Plague and Marcomannic Wars from AD 166 to 180, when the silver content fell to about 75% as the empire struggled with depopulation and reduced tax revenues. Emperors increasingly turned to the mints to bridge deficits, diluting the currency rather than raising taxes that might provoke rebellion. The crisis deepened in the 3rd century, a period historians call the Crisis of the 3rd Century, from AD 235 to 284, marked by 50 emperors in 50 years and constant civil strife. Septimius Severus began paying soldiers in debased coin, dropping purity to 50% by AD 194, while his successors like Caracalla introduced the Antoninianus, nominally worth 2 denarii, but containing only 1.5 times the silver. By the time of Gallienus in the 260s, the Antoninianus was little more than 5% silver, often mere copper with a silver wash that quickly wore off in circulation. Diocletian's reforms in AD 294 attempted to restore confidence with a new silver argenteus and gold aureus, but ongoing military demands undermined these efforts. Aurelian had briefly improved standards in the 270s, yet the cycle persisted until Constantine introduced the solidus gold coin in AD 310, shifting reliance away from the thoroughly debased silver series. Over these 3 centuries, the denarius and its successors lost nearly all intrinsic value, contributing to economic instability that weakened the Western Empire's cohesion. Rome's debasement operated through a straightforward, yet insidious mechanism. Emperors ordered mints to reduce the precious metal content while maintaining the coin's face value, effectively creating money from thin air to cover expenditures. Each reduction in silver fineness, from Nero's 10% cut to the near-total elimination under the Severan dynasty, allowed the state to mint more coins from the same bullion stock, funding legions and public works without immediate tax increases. This seigniorage profit came at the cost of gradual inflation, as merchants adjusted prices upward when they noticed the lighter or tarnished coins passing through their hands. In contrast, the Federal Reserve employs far more sophisticated tools to expand the e-money supply, achieving similar dilution without physically altering coins or notes. Established in 1913 to stabilize banking panics, the Fed gained expansive powers over time, particularly after the United States abandoned the gold standard domestically in 1933 and internationally in 1971 under Nixon. Since then, fiat dollars are backed solely by government decree and public confidence, enabling money creation through open market operations, quantitative easing, and interest rate manipulation. The mechanism accelerated post-2008 financial crisis, when the Fed's balance sheet ballooned from under $1 trillion to over $8.9 trillion by 2022 through asset purchases that injected trillions into the economy. This digital money creation mirrors Roman debasement in effect, increasing the quantity of currency chasing goods and services, thereby eroding purchasing power. Consumer Price Index data shows average annual inflation of about 3.8% since 1913, compounding to the $96-97% loss in value over a century, with sharper spikes during wartime and recent stimulus periods. Consequences in Rome manifested as rampant price inflation during the 3rd century, with wheat prices rising hundreds-fold and the economy shifting toward barter in provinces. Trust evaporated, soldiers demanded payment in kind, and tax collection became coercive, contributing to social unrest and the empire's fragmentation. Modern parallels appear in wage stagnation relative to asset inflation, growing wealth inequality, and periodic bouts of high inflation that disproportionately burden fixed-income households. Both systems reveal a core vulnerability. When governments face unsustainable commitments, whether Roman legions or contemporary entitlements and debt servicing, they often resort to monetary expansion over fiscal restraint. The Fed's actions, while stabilizing short-term crises, have sustained elevated debt levels exceeding 120% of GDP, echoing Rome's reliance on debasement to postpone reckoning with structural imbalances. The big truth emerges from the annals of his story. Currency debasement is not an accident, but a deliberate choice by those in power to transfer wealth from savers and workers to the state and its favored institutions. In Rome, emperors and their inner circles profited from seigniorage, while the broader populace bore the burden of rising prices. In the modern era, central banks and governments orchestrate expansion that benefits asset owners and debtors at the expense of those reliant on wages and fixed savings. What Rome required 300 years to accomplish, reducing the denarius from pure silver to worthless bronze, the Federal Reserve has paralleled in purchasing power destruction within just over a century, with the steepest declines since the end of the gold standard in 1971. Federal Reserve data and historical CPI calculations confirm the dollar has lost over 96% of its value since 1913, a rate accelerated by repeated cycles of crisis response that prioritize short-term stability over long-term soundness. Power structures remain remarkably consistent across millennia. Just as Roman mint officials answered solely to the emperor, modern central banks operate with independence that shields them from direct democratic accountability, enabling policies that sustain high debt and deflect fiscal reform. This insulation allows the continuation of expansionary measures, even as public debt surpasses levels unseen since World War II. Current implications extend far beyond domestic borders, as the dollar's role as global reserve currency exports inflation worldwide, compelling other nations to accumulate dollar assets or risk competitive disadvantage. Yet cracks appear. The dollarization efforts by major economies, surging gold demand among central banks, and persistent above-target inflation signal eroding confidence in the system's sustainability. In the end, history does not repeat, but it rhymes with chilling clarity. The path of least resistance, monetary expansion over hard choices, has undermined empires before and threatens to do so again unless confronted with resolve. The question is not whether the cycle can continue indefinitely, but how much further the erosion will proceed before the foundations of trust give way.